When it comes to investing, retirement, taxes, healthcare, and estate planning, the decisions you make today can greatly affect the quality of life for you and your loved ones tomorrow. What you need is straight and unbiased information on the most important issues you'll face when planning for your retirement and financial future. Good news, you found Premier Retirement Radio with Jeff Vogan. Jeff is the founder of Premier Retirement Planning and Wealth Management, and he's been guiding people financially and into retirement for 30 years. So get ready for an hour of the most comprehensive financial information on the radio. Premier Retirement with Jeff Vogan. And now here's Jeff Vogan and Jeff Shea.
Thank you so much. Welcome to Premier Retirement with Jeff Vogan, the radio show that gives you the straight talk and honest answers you need to reach your wealth management and retirement goals through smart investing and careful planning. On today's show, we're going to be talking about global conflict, rising rates, and retirement risk. We'll also touch on sequence of return risk, also listener questions, and finally, how the IRS taxes retirement income. My name is Jeff Shea. As always, I'm just here to ask the questions, but the words of wisdom and solid advice, they come from the other Jeff in this radio program. It is Jeff Vogan, founder and president of Premier Retirement Planning and Wealth Management. Jeff, how are you doing today?
I'm doing great. How are you doing?
I'm doing fantastic. Thank you. It is the first weekend of March here already. We're talking off the air. Daylight savings time is going to come back for a lot of parts of the country, but here in Arizona, we do not change. But if you do business in other parts of the country, you'll have to do it just about 1 hour earlier. Anyway, let's talk about what's going on in the news and in the world. Jeff, there's a lot going on this week, a lot happening right now. Geopolitical tension, inflation data, bond moves, retirees are wondering what it all means for their money. So let's start with the headlines. The U.S. and Israel conducted strikes on Iran. Oil prices jumped a little bit. Markets reacted. What should retirees really understand or take away about this situation?
Well, it depends. If they've got an overall plan where they've kept enough of their money safe and protected so that their income doesn't get interrupted, then they shouldn't lose any sleep. If you've got everything in tech stocks and even gold and silver that's been selling off lately a little bit more than expected, sometimes it's a safe haven, it isn't. Depending on what your investments are, you might be a little bit worried, or you might want to reshuffle the deck a little bit. Energy and oil is certainly going to be strong given the nature of a Middle East conflict. It might be a little longer than expected. Hopefully they'll get in and get out. I don't know that ever happens in the Middle East, so there might be kind of a long-term deal. There'll be certain shipping and transport companies that are probably going to do very well as far as stock investments. We're moving to those now and been doing very well all week. We've got certain tech companies still have a niche and are still holding up pretty well through this week. Although if you look at the Magnificent Seven, the stocks that basically drove the market for the last few years, if you look at the 1 day, 1 week, 1 month, 3 month, and 6 month, the last 6 months, all of them are down, trending down, significantly down, 7% year to date or more. I think 8 or 10 maybe now by today. But those are the stocks that basically gave all the gains to the S&P 500, and all the others were flat compared to those 7, and those 7 are struggling. So some of the big companies that have been a little bit overbought, a little overhyped, are kind of settling back into reality. You know, certainly the conflict and the what ifs and how is it going to affect regular investors. And for those people that do live on their investments, they're probably running scared and going to be running for the cover and going to be selling and maybe a little bit overdone, given the fact that I think the economy, regardless of a war in Iran or depending on how big it gets and how many countries get involved, may or may not be a big deal from the standpoint of economics. But if it is a big deal from the standpoint of people's comfort zone, being in the market or being exposed to possible sell-offs or another 9/11 attack where the market shut down for 3 weeks and nobody knew what it was going to open up at, and everybody was 20% or more poorer when it did open. So I think some people do have a memory of that. Some people have no memory of it. But those people that do, or those people that realize that there is risk associated with war, might be running for cover. So that's why I think there might be a little bit more, over exuberance in the sell-off pressures or the volatility like we saw this week and probably we'll see on into the coming weeks. We're hyper vigilant from the standpoint of the stock market. We watch the money and see where it's going, and we make those adjustments in our portfolio accordingly. But when you're dealing with the big firms and the Fidelities and Vanguards and those big people that have trillions and trillions of dollars in funds, they really can't do anything but maneuver other than just ride the market out and tell you to hang in there so that all their friends and rich people can sell and take profits, and they can do the same and hope you can ride it out and not get hurt. But the thing is, a lot of people do get hurt when the market sells off. This is one of those things that is a catalyst for a typical sell-off or even the start of a good reason for a bear market. It may or may not happen because there's still a lot of money out there that is probably happy to buy stocks even at these overvalued prices and continue to drive them up. Nevertheless, we've seen hedge fund managers dial it back. We've seen Warren Buffett dial it back. We've seen Dalio and those other big, huge hedge fund managers that have trillions of dollars in investments basically raise cash lately. So they're expecting something to be a trigger or a catalyst to a market sell-off. And certainly this war issue isn't helping it. I think defense stocks, you might see some strength there. We already did earlier in the week with Northrop and some of these other stocks that build the planes and the missiles and stuff that they're shooting up and going to have to replace. Raytheon and things like that will likely do well during this type of a time frame. But if you've got a huge portfolio that has everything and they leave you diversified, the things that are getting hammered are going to be drawing your portfolio down. If you have an active manager like us, and we're not the only ones, but some people do hands-on tactical management, we're going to probably leave those ones that are soft alone and try to focus and kind of load up on those stocks that seem to be strengthening during this conflict, oil, defense, that kind of thing. So if you have money in the market you can't afford to lose, then you should be running scared, maybe dial it back a little bit and put something into some principal protected accounts. We do have principal protection on our LIRPs, on our annuities, indexed annuities and indexed IUL, indexed universal life insurance policies that we use. Those are principal protected. Those are insured and secured accounts. The balance does not go down when the market crashes. It stays the same. Now, it goes up when the market goes up, and it doesn't go up maybe as much as we could do on managed money, but it gives you the safety net, knowing that when times like this come, when there's a lot of uncertainty, that you don't have to run in and sell half your assets at a loss. I mean, shoot, I remember Tuesday I woke up to a down 5.5% at the open, bounced back reasonably well, and we made some changes during the week. But if you're living on that money, you have a few days like that, you should have a gut ache. But if you've got 3/4 of your money in safe places and you don't have to touch it, and we can let it bounce back and give it some time before our next paycheck that we have to take out of that, because we don't have to take money out of that account, then we can be a little bit more calm and cool and collected about it. We can just kind of let the market do its thing, and we can let the managers do their thing, and we can live on the income that we've already set up to pay our bills and to give us a little bit extra for fun stuff. So if you set up a good comprehensive retirement plan, the ones like we set up, I really doubt, in fact, I haven't had a call yet this week that of anybody worried like, oh my gosh, Jeff, this war, am I okay? Am I okay? Because they know that they're okay, because they know that they're getting their monthly paychecks and they're coming out of principal protected accounts. They're not locking in losses, and that they can typically ride this out. Now, we may end up getting a few calls, but in some firms, when it's all or nothing markets type stuff, even stocks and bonds, and the bond market hasn't really held up that well lately either. Done okay, but over the last few years, we're still significantly down from their market high. So bonds are not necessarily a safe haven. Gold seemed to be kind of a way that a lot of the hedge funds were going, but we've even seen that gold and silver sell off recently. So what can you count on? I don't know. It's all kind of a guess. You have to use logic. You have to use reasoning. You have to use rationale. You have to look at where the money's going and try to follow that, which is what we do. And that's what people hire us to do, because they don't have access to the information that we do, that we pay a lot of money for. But, if you're not able to navigate the market and guess it, then you shouldn't be in it, especially if it's money that you need to use on a monthly basis or to supplement your living expenses, especially if you're retired or getting close to retirement. Now, granted, the people that aren't retired, maybe they're in their 40s and have 20 years to go, or even in their 50s and have 10 years or more to go, probably don't have to worry at all about these little market corrections. They can keep on putting money in. In fact, a little market sell-off would actually help them buy in at a cheaper price on a per stock share price basis. And they'd actually dollar cost average into more money in the future. The people that are still in the accumulation phase should welcome a big correction, because then you get to start low and you get to buy low and then sell high when you retire. If you've already retired, I hope you already sold at the high, because you should have taken profits. You bought low your whole life. Now you should sell at the high point. We're still at a very high point. We're just a few points off of record highs in all the indexes, even though the indexes, I think, year to date are down probably on average 3 or 4%. And for the last 6 months, somewhat flat. But if you look at the last couple of years, we did really good, and you're still able to get out with a nice profit if you haven't gone to take some profits and gone into some principal protected assets. I think now might be a reminder of how volatile the market can be when, bad news hits or some new macroeconomic event happens. And I would say a war is a macroeconomic event, because it does filter into the economy, not just a geopolitical type thing. But there's times to rethink and regroup and reevaluate your asset mix and assess whether these assets are for long-term growth and you can wait on them, or whether they're for supplementing your Social Security and pensions in retirement, or whether you're going to retire in the near future. And who knows, maybe this is the start of the next big 50% correction. I don't know. I hope it isn't. We're certainly not going to ride it all the way down with our investment money, but people that are in the market, maybe they don't have a choice, or maybe they're coaxed into the mantra of Wall Street, hang in there, it'll always come back. Well, not if you're spending money, it doesn't come back. It locks in losses and you end up running out of money. So you have to be careful, depending on where you are in the retirement planning cycle, phase cycle, or in the retirement cycle itself, on whether or not you've set aside enough money to provide that guaranteed income that you need, or at least a predictable income need, so that your bills are paid, that you have the peace of mind to sleep at night and to continue to live your retirement on your terms, not just based on what the market tells you can do. And some people are so invested in the market that they've never taken risk because they're scared to death of what might happen in the market. And I meet them from time to time. They come in and say, I've just been worried about, I haven't been able to spend money because I'm so worried that if it crashes, I won't have any money, and blah, 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 blah. And I'm saying, well, why would you do that when you've worked so hard to retire with peace of mind and confidence? yet you're in the market where you don't have confidence. Well, it's because their advisors only offer stocks and bonds and risky investments, and then say they're fiduciaries and they build portfolios for the long haul. Well, the long haul isn't for somebody that's taking their money out. Yet some of these people, even on TV, say, oh, annuities are stupid, or anything that you would buy that would secure your assets is a dumb thing. Well, it isn't a dumb thing when the market goes down. I mean, you can do the math. You can look at history. But of course, these companies don't offer those products that protect your assets, don't provide income, provide tax benefits, and all the things that we do. As a smaller boutique type firm and a comprehensive planning firm, we can deal with a very unique or very similar client base. Those people that have worked hard, have money, and want to save taxes, and create an income plan using all the tools that are in the bag. Save taxes, maximize income, protect against risk, and do all those things that the big boards and the big institutional managers that got you to retirement don't do. They don't get you through retirement. They don't have strategies to do that. They say they do, but honestly, they don't work. If you look at history, if you look at market volatility, if you look at the story about Norm that I tell over and over again, how he retired in the year 2000 right before the market crashed, $1 million in his 401k, which is like 3 or 4 million nowadays, and ended up losing it all in the market because he was spending that money. And his broker said, hang in there, it'll come back. Well, it didn't come back because he had to live on that money for 3 years. And half of the money that he lived on was basically half of his principal, what it turned out to be as the market corrected. So I think right now, although I don't have any fear myself because we haven't, I personally won't lose sleep over my clients' portfolios. If you come to me and say, hey, I want to risk all my money, I'm going to say you probably should find another investment advisor. There's plenty of them out here. In fact, some are in my same building, some are straight across the street, some are within a mile here. Within a mile here, you have every financial advisor probably possible if you want to go and risk all your money. And very few that will say, you know what, let's not risk all your money. Let's just invest and trade a small portion of it. Yeah, it's okay if we only make fees on a portion of your money because we're going to set you up with these other assets that provide income, provide stability, provide peace of mind, provide tax benefits and other things so that when bad news comes that we bomb Iran or we find out that terror cells are going to start causing trouble here, even on the homeland, I hope not. But if that happened and people get even more scared, it's very common that people kind of gather their chickens, right? They basically sell their assets, gather their money, stick it under their pillow, stick it in a safe place, put it in the bank, put it where it's liquid. And people sometimes are scared about what the market might provide. So you might see a lot of the Main Street investors that were wooed and suckered into over-investing in the stock market get more scared than even institutions, who, by the way, have already started paring back their investments, might be running for cover in big amounts. And since there's so many Main Street investors, households that own stock, more so than probably any other time in history, and the top 3 times in history, right before big market corrections have happened, the 29, the 2000, and the 2008 crash, at all those times, more than 60% of households were stockholders, were stock owners. In other words, Main Street was a big, vast majority of those stock ownership, represented a big majority of stock ownerships. And so when the market gets scary, they're the ones that get scared first, they get scared the most. They also have the most to lose. If the market goes down, institutions, they've got tons and tons of money. They've got a plan that they can kind of ride the wave through volatility, but somebody with just enough to retire on and just enough to create a nice, steady income from doesn't have that same, stability or that same foundation of huge amount of money. They've got to protect what they have. And so typically they'll run for cover, which will exacerbate whatever market correction might naturally come. They know that they have to run for cover and take profit. So if you think this is going to be a prolonged situation where there might be more selling, we haven't really seen whether it is yet or not, but we've only been in this thing a week. But if it looks like it's going to be a long-term thing, then we're going to go to cover and hoard cash too, just like the other big boys. In fact, we don't have to do that right away, or we haven't had to do that over the last few years because we've already done it. We've put assets in principal protected accounts. So the thing is the Buffetts and the Dalios and the big hedge fund managers that manage huge amounts of money, they're putting all their money in cash. They're not making any money on that cash. They're just waiting to buy cheap. What we're doing with our safe money is we're not putting it in cash. We're taking a third or 2/3 off the table and putting it in assets that have still grown by 6 or 7 or 8% in the last few years safely, better than CDs or safe money, better than cash. And when the market corrects, they don't lose money. So those are the assets that we want to use for the continued steady income. And we want to be possibly even more aggressive with the smaller amount that we have in the market. And that's why when we manage money, we are aggressive because it's not with an amount that you have to protect for income. We've already done that with other tools. So I might have got a little off track, but what about all this geopolitical risk and all this news that's happening? Is it making our heads swim? Is it making us worried? A lot of people should be worried. A lot of people probably are worried. I don't believe our clients are. And if there's anybody listening that is a little bit worried and you haven't really been offered or shown the alternatives to help you weather these type of storms or weather these type of news flashes safely or with confidence or without getting a big gut ache, then maybe we can talk to you about the diversification that we do. And it isn't diversification into 16 different mutual funds and 35 different high-tech stocks and hold them till the end because we think in 10 years they'll be good and we'll just ride it out and hope it works. It's basically taking some of that money off the table, securing it for use when you need it. We can actively manage the rest. So again, I said earlier, I don't like to be put in a position where I have to worry about your money. And that's why we insist that people make sure that their income needs are met with secure products that are built for income, that are built for times like these when volatile markets could otherwise erode your assets and cause you to run out of money in retirement rather than live comfortably on it.
Talking with Jeff Vogan of Premier Retirement Planning and Wealth Management here in Tucson and Mesa. And we're talking about current events, what's happened this past week with Iran and Israel and the United States involvement in that. If headlines are making you feel even just a little uneasy, oil spikes, market swings, inflation concerns, here is the real question. Is your retirement plan built to handle it? Because hope is not a strategy and guessing is not a plan. At Premier Retirement, we help retirees and pre-retirees answer the questions that really matter. Can I generate reliable income no matter what the market does? Am I taking too much risk or not enough? Could inflation quietly erode my purchasing power? Is my portfolio positioned for today's interest rate environment and today's geopolitical events? Well, right now, we're offering a complimentary Premier Retirement Roadmap for you at no cost and no obligation to talk about these concerns. To get yours, call 520-780-9059. It's 520-780-9059. You can make that call right now to schedule your Premier Retirement Roadmap review, because when the world feels uncertain, your retirement plan should not be. Once again, it's 520-780-9059. You can also find out more about us online at premret.com. That is PREMRET.com. Jeff, let's talk about our next topic here, and that is sequence risk. Fix it by separating cash flow from growth. The market's been strong lately. Why is now the time to talk about retirement risk and sequence of return risk, do you think?
Well, that's part of what we build into our plans. If you are retiring tomorrow and the market corrects 50% in the next 2-3 years, or even in the next 6 months, because we're probably due for a big correction, we can't rule it out. It could be that big. Some people say, it won't happen this time. Those are just things of the past. Well, they're things of the not too recent past. We've had 2 market crashes of more than 50% just in the last 25 years. And we're overvalued to a higher extent than we were at that point. If you look at history values and the fact that the market always returns to some sort of equilibrium value. If you look at fair market value being about half where it is right now, we could very well have the market tank. Now, if you are 10 years from retirement, you should welcome such a thing, because you can buy for the next 10 years at a reduced rate and actually have more money than you would if you just stop investing. If you have already made a bunch of money, given the fact that the market is at an all-time high or near that, every market correction, every big crash and every little crash came after a recent all-time high. So keep that in perspective. Just because it's an all-time high doesn't mean it's going to stay there, because there's always been all-time highs before any big market correction or a crash. So, and I'm not calling for a crash. I'm just saying we have to be aware of it. Yeah, I've been saying this for a few years. I actually thought we were a lot more close to it a few years ago when Biden's policies were causing a lot of inflation, money printing and things like that. There was obviously some inflationary things going on. They were kind of trying to fix the market with interesting means, but it did finally correct. There was so much money out there that people just bought it up, and we kind of weathered that storm. But now that we have a little bit more clear indication of where the money's going, and there's a little bit more, I guess we're getting tipped off a little bit more easily with the Trump administration. We've been able to do a little bit better with market picks and our market confidence. But nevertheless, you still have to respect the fact that it can correct any time, that there's not a guarantee that you can get out in an hour or a day or in the week that it crashes, or if there isn't some huge 9/11 type event where the market just shuts down, you don't have a choice. You have to wait it out and see what happens. So there are some risks that we can't control. And if you're retiring just right at a point where, let's just say, your goal is to have $2 million saved that you can convert into $100,000 roughly worth of retirement income, and all of a sudden the market gets whacked and it goes down 10 or 20%. You say, well, that's okay. I'll wait till it comes back. If you're starting to spend money in retirement, you're going to lock in those losses. That money isn't going to come back. So if that sequence of returns, if the sequence is a bad start right out of retirement, then you stay at a bad start. That's kind of like your new start point is less. And if the market continues to go down, let's say it is a 50% market correction, we've had those, then you have $1 million, and now you can only live on $25,000 extra per year than the $50,000 you thought you were going to live on. That's $2,000 a month that you don't get to spend, and you're kind of locked into that because money that you spent isn't going to come back. And if you retire right at the peak of the market in the .com bubble and it blows up and you're spending money, that money doesn't recover. You have to get jobs, you have to take Social Security early, and then if you finally start getting that money crawling back little by little, but keep in mind, for the last few years you spent money, that money might make up a third of your assets, perhaps. Well, that's a third that doesn't grow anymore. That's a third that doesn't last 20 or 30 years to cover your expenses. Inflation comes along. The only thing you get a cost of living adjustment on is your Social Security, and you can't raise your income because you don't have enough money there anymore because the market corrected early on in your retirement. Let's say you have a couple $1 million and the market has already crashed because you used to have $4 million. Well, then you still better make your plan based on the $2 million that you have left. I wouldn't go back and say, well, yeah, but I had $4 million. It's going to come back. You have to really base it on where it is at that point. So if you retire when the market is fairly valued or low valued, you can have a better level of confidence knowing that when you do pull money out of those assets, you're less likely to have a big hit or a big loss. But I think going into the market right now and going into retirement right now will be a little bit scary for anyone that knows that the market is historically overvalued and could crash. And if you have to use that asset for living on, then it's a bad thing. And that's why we say, take the profits off the table. You've done really well. You can actually get a premium for all your investments right now. You can actually get more than they're worth. It's like you have a house that's worth $500,000 and somebody offers you $700 for it. Would you not take it? Well, no, I just want to live in my house. Okay, well, then you just want to keep your stock. Well, that's fine. If that stock you're not going to need to use to live on, it's a different story. But when you get a chance to get a premium, sometimes it's great to just take profits and be happy. You take those profits and you put them into assets that will guarantee income, more income, in fact, than the 4% rule that Wall Street has always touted as being the rule of thumb, which is kind of weird since the stock market averages 10%, bond market averages 4 or 5, and yet you can only take 4% out. Well, that obviously reiterates the fact that there's a return or a sequence of return problem, and volatility hurts an income plan more than it hurts a growth plan. So get your stocks and bonds during the growth phase and get your income plan and protect those assets during the income phase. That's what we do. We have to use insured and secured products built for income. Unfortunately, Wall Street doesn't seem to sell them. They don't have anything. They could sell you a bond that says, oh, it has a dividend or it has an interest rate of this, but that interest rate or that dividend can change any time. The stock market crashes, you lose half your value on the dividend stock. Oh, and the dividend percentage acts like it goes up, but then they readjust the dividend percentage down to where the stock value is, and then all of a sudden you're getting half the money you thought. And if you need to sell that stock for any reason, you get half the money that you paid to buy that stock. And I can show you several dividend stocks that have done that over the last 5 or 10 years, that they've gone down just as much of the dividends. So you really haven't made any money. You've just been kind of holding your money flat and haven't been making enough to supplement your lifestyle and supplement the income that you need. So again, sequence of returns is a big deal. Right now, we're looking at an event that could cause a bad sequence of returns, meaning that we could have a down year. And it kind of depends on whether you retire in an up year right before a down year, or if you retire in some down years right before a few up years. If you retired in the year 2003 after the market was down, you had $1 million, you sure did a lot better on that over the next 10 years, even with the market crash in 08, than you would have done if you retired in 1999 or 2000, like the story that I tell about Norm. Norm is a real person, and he worked for a chip company up in Phoenix and made a good living and thought he'd have a good retirement. And unfortunately, he didn't. He lets me tell the story because I couldn't actually help him. He dug too big of a hole. His retirement plan failed. He pretty much died on the retirement mountain, so to speak. I told him I really couldn't dig him out, but I wished him the best and asked if I could share his story. And he said if I thought it could help people, then it was fine. So I have been telling that story. So sequence of returns is real, especially when you're looking at a multi-decade of retirement. Most people aren't going to retire at 60 and die at 70. They're going to retire in their 60s and die in their 90s or 100. Who knows? That's, a potential 30 or even a 40-year retirement plan that you need to have everything you worked for 30 or 40 years become and create income for the next 30 or 40 years. You don't have a job creating new income anymore. You have to use what it makes, and you cannot afford losses. You can't afford to lock in those losses. Sequence of return is a real thing, and it will wipe you out if you don't set some of your money aside in some principal protected account that you can use for income while the market recovers and while you have to wait on those market assets to get back and start making money again. So again, it's not really rocket science. It's just looking at the math and looking at the volatility, looking at history, and putting some scenarios together. We use a spreadsheet where we can show you different scenarios. We can plug in different what-if scenarios and show you what would happen if the market crashed. Would you actually still have money when you're 90? If you put some in a protected account that only made 6% and the market crashed, would you still have money in your 90s? The answer would be like, wow, way more than if I lost half of it in the next market crash, even though the market might average 10% or more. For the last couple of years, it's done very well, but add 2022 in it, it's not done that well. If you add this year into it, so far we're down. Hasn't done that well this year. It might end up not doing well this year, especially if we have a protracted war in Iran and other things start happening in the homeland, or who knows? Nobody knows the future. Nobody has a crystal ball, and that's why you need to plan for the worst, hope for the best, but plan for the worst just in case it happens, because it never broadcasts when it's going to happen. It just happens. The market does what it does. The market does what it needs to do, but it never tells us when it's going to do it. We can guess, and a lot of people have been really lucky guessing, and they made a lot of money by, being considered gurus because they guessed. But you're only as good as your last guess, and nobody knows whether the next guess is going to be right or wrong. So plan for any situation. And as long as you can handle the good markets and be happy, and also handle the bad markets and be happy, have all your bills made, and not have to rely on that market-based asset bucket that is getting hammered in bad times, then you'll live a longer time. You'll have less stress, probably not shorten your life expectancy by extra stress. that some people, I think, go through when they have everything tied to the market. So it doesn't have to be a lifestyle change. It has to be just a commitment to confidence and a commitment to a plan that makes sense and protects during these times.
Jeff, running a little short in this segment for time. Want to remind people that if Jeff's comments resonate with you, you'd like to get in and sit down and talk with him, it's 520-780-9059, 520-780-9059. You can also find out more about us online at premret.com, premret.com. Jeff, time for a break. When we come back here on Premier Retirement, we've got listener questions and more when our show continues here on 790 KNST, Tucson's most stimulating talk.
You can't start a trip you've never taken without a plan, and you can't start your retirement journey without a comprehensive plan to get there safely. To request your no-cost Premier Retirement Roadmap, call 580-780-9059 or request it online at premret.com. Now back to more Premier Retirement with Jeff Vogan and Jeff Shea.
Thank you so much for making us part of your weekend. You're listening to Premier Retirement with Jeff Vogan, founder and president of Premier Retirement Planning and Wealth Management, with offices right here in Tucson and also up in Mesa. Once again, we're on the air for you 4 times a week here with our fine radio program. We're heard Saturdays at 7 a.m., 9 a.m., and 1 p.m., and also Sundays at 11 a.m. and 24 hours a day. You can also find us on our podcast. Go to wherever you get your podcasts. Search for Premier Retirement with Jeff Vogan. You'll find this show and all of our past shows so you can stay on top of your journey towards confident retirement. Once again, our phone number 520-780-9059 if you'd like to come and sit down and talk with Jeff about your journey towards a confident retirement. Okay, Jeff, time for listener questions. We'll start with Mark in Vail. Mark says, what are some creative ways to generate supplemental income in retirement besides Social Security and pensions?
The Wall Street method is just take a withdrawal rate that's reasonably low and you shouldn't run out of money. Let's hold and hope the market performs, blah, blah, blah. Our mantra is use all the tools in the bag. You don't have to use just the stuff that gets you to retirement. It's not necessarily stuff that gets you through retirement, in our opinion. It's a totally different thing. When you're talking about income, it's a new story. You're talking about growth, it's basically the old Wall Street story, and that's fine. And I hope you've grown your asset bag to, a big amount so that you can retire with confidence. But you need to take some of that income off the table and create that extra, the security and the peace of mind, because Social Security for most people only covers about maybe a third of their total as far as their lifestyle goes in retirement. So what do you use? Well, there's a thing called an annuity, which, by the way, Social Security is an annuity. A pension is an annuity. It's basically just anything that generates a guaranteed or a systematic income that you can count on. And I think it's awesome that if you know that there's, let's say, $30,000 a year coming in on Social Security, that's going to pay at least some of your bills, your food and gas money. But what's going to pay the rest of your bills, your fund? And you have a pension. Most people nowadays don't have a pension, so they need to make a pension with some of their assets that they've saved. For example, you have $1 million in retirement. Maybe you put half of that into an annuity that pays you another $40,000. Now you're up to $70,000 guaranteed. And if you have no bills, maybe that gives you enough to live on. Then you take the other $500,000 and you invest in the market, try to make 10 or 20%. But if the market crashes, you don't have to dip into that bucket and lock in losses because you have some savings in the bank for your emergency funds and things like that. And you can maybe wait a few years for that market money to start resuming its uptrend. Or you might say, how about 80% in my guaranteed income? That way I don't have to worry about so much of my money, and I can go even more aggressive on 20% of my assets. Put 80%, maybe that'll generate $60,000 or $70,000 in income. Now I have $100,000 guaranteed to live on forever. But that $1 million in a 401k, according to Wall Street, and a new study that Schwab did, and some older studies after the lost decade of the 2000-2010 crash by a guy named Wade Pfau, who's actually an actuary that has a PhD in retirement income, believe it or not. They've even made majors in retirement financial studies a part of curriculum in some financial majors at some colleges, in fact. And he says that the rule of thumb should be about 2%, because if you retire like Norm did and take more than 2% of your money, you might not make it a 30-year or 35-year retirement. The old Wall Street method was formed in 1993, I believe it was, by a guy named William Bengen, who was a CFP, and he basically did a whole bunch of calculations. I figured based on the historical returns of the market, when I want to live 25 years, how much of my stock and bond portfolio can I pull out within a bell curve of probability, in the statistical bell curve, which is, in the very high 90s, almost 100% probability that you won't run out of money. He came out with a 4% rule. And so that's kind of what the rule of thumb has been. So you can't take more than 4% of your money. So $40,000 is what you should be able to take out of a $1 million stock brokerage account, according to the old rule. According to the new rule, it's 20. So somewhere in between that's probably 30. And that's what the Schwab story came up with. It was just a little over 3% was kind of the safe rule of thumb for the amount of money you could take out of your assets without jeopardizing the chance that you'd run out of money, or had to plan for that you could run out of money. So you needed some other backup plan. Well, why not have a backup plan where you can take 50% of that money and create at least the 4% rule, like create at least a $40,000 income and still have $500,000 in liquid money you can play with, or even do better, like I said, 70 or 80% of it and get another $50, $60 or $70,000 potentially in guaranteed lifetime income, regardless of what happens to that account. Now, let's say you put $800,000 in some sort of principal protection, and then you had $200,000 that you could just risk. And let's say you did the market average of only 10 or 12%. Let's say you were able to be more aggressive and beat the market with good managed money, you can. But let's just say 10%, that's going to double every 7 years. So let's say you live, just say 28 years, just so we can have a nice 7 number. So in 7 years, that 200,000 goes to 400. You've still been living on more than you did before. In 14 years, that money goes to 800. In 21 years, now it's 1.6 million. And in 28 years, at a 10% average rate of return, it's $3.2 million. So on the 4% rule, if you're taking $40,000 out per year on $1 million, I think it's pretty hard to believe that a stock and bond portfolio is going to be worth $3.2 million after you've pulled $1 million out of it in up and down markets over that same period of time. So if you're worried about what if this 800 is gone and what if it only guarantees me this much income for the rest of my life, the 28 or 30 years that I might live. Oh, and by the way, if you die before the money's gone in that account, because it is principal plus interest that they're guaranteeing that they can give you, while the other money grows to more than you started with, the balance of the account that you're drawing down is still available to heirs should you not outlive it. So it's not like an old school annuity that gave annuities a bad name where you give all your money to an insurance company, you get an income, and when you die, the insurance company keeps whatever's left in the bucket. You get that bucket for your heirs. So annuities have become a lot more friendly. That is one alternative. If you want an annuity on steroids that's tax-free, you can do what's called a LIRP, life insurance retirement plan. You have to pay tax on the money, kind of like a Roth, before you put it in there. So if you have after-tax non-IRA investments, it's perfect for that. But if you have some IRA investments, but you don't like the tax part of them, so in the future, when you start pulling that tax money out, it's going to be taxable. And as you get older, they force you to take more and more of your IRAs, 401ks, and deferred accounts out. If you don't want that, then you can pay taxes now on less money. Never pay tax again in 2 different ways. A Roth, which you can also put annuities into and get a tax-free stream of income, or in a LIRP, life insurance version of that, where you actually don't pull the money out when you use it. You actually borrow against it, meaning that it stays in the account and continues to grow. And the borrow rate is typically, if you set it up right, borrow rate is equal or less than the gain rate on the money. So you're not digging into principal, you're actually growing it faster than you're spending it. So you actually continue to get interest on money you're spending. Kind of a magical scenario, if you ask me. In fact, more rich people use it than poor people use it. Why? Because they like the tax-free benefit of tax-free income and the fact that it's stealth. It doesn't generate 1099s. The government doesn't track it. It's kind of a way to shelter money and to hide it in a way. We call that the Roth on steroids because it does generate tax-free income. It goes to your heirs tax-free. It also provides a long-term care benefit for long-term care insurance, or for terminal illness. You have access to the future death benefit that life insurance provides even earlier than death so that you can use it during life. And that's what I think truly life insurance is insurance that insures your income and provides benefit during your life, not just on death. I think the reason most people buy life insurance, it should be called death insurance, because it's like you're only buying it so you can make somebody else rich when you die. What about you buy it and you structure it to where you get all the benefits while you are alive and you just leave the balance tax-free to those who you love? Meantime, you live on it during your lifetime. So you basically get to spend your own death benefit for you, not for your heirs. Now, if you want to make somebody rich, that's fine. Death benefit might be appropriate for you. But, most of my clients just want steady income, stuff that they can count on, saving money in taxes, and know that their bills are going to get paid. And then they're able to put at risk, if they want to, the rest in the market and try to get some growth on the money that they don't need on a day-to-day basis. But that was a good question. I love income. That's really part of our planning. You asked the right guy, I think, for that. So hopefully you got a good answer, probably a very thorough answer. There's a lot more we could talk about, but I don't have more than an hour on the radio, so you got to cut it, leave it at that.
Well, Mark, that was a great question. We appreciate you listening to us in Vail. And again, if you want to have a further conversation with Jeff, the phone number 520-780-9059. We invite you to call us anytime. Jerry's listening to us in Catalina Foothills, Jeff, and Jerry says, how can I structure my retirement accounts and taxable investments to minimize tax hits for myself and my heirs?
Well, your taxable investments, if you're trading on a regular basis, or if you have mutual funds and things like that, and I'm talking about the non-IRA investments, you're going to get a tax hit every year based on how much you made. And if there's trading going on in those funds, you might get a tax hit. Now, we have some managed funds that are not tax friendly, but typically our performance more than covers the taxes. So sometimes you can use that to justify whether or not you really are okay with the taxes or not. But we like to do the accounts that generate a lot of trades and might otherwise generate income. We like to do that in IRAs, which don't generate a 1099 and don't cause you tax problems. In the non-IRA assets, you could do what's called tax-deferred annuities, which basically are like a CD, but you don't pay taxes on the interest, and you can continue to roll those over till you die if you want to. But you can also let them accumulate and use those as rainy day funds for maybe future nursing home bills or some sort of medical expense that you could write off, so that the interest that you accrue on those on a tax-deferred basis, that compounds on a tax-deferred basis, ends up coming out for those expenses that are potentially tax deductible. The other thing is, if you have several heirs and they get to divvy up that annuity account that's been tax deferred for your whole life. By the way, I just saw an annuity came over across my desk that guarantees 5.9% for 5 years. That's better than a CD anyway. But if you just want some safe money, you don't want to pay taxes on it, you can guarantee some growth, and that might be something that suits you. If you want to do something that has great growth potential, but you don't pay taxes on it until you sell it, you can use ETFs, exchange traded funds. But you have to pretty much decide to hold them for at least a year or even longer term in order to get a tax efficient sale price, because you get capital gains treatment on it, because the trades or the balancing that goes on inside of an ETF is typically a sector related fund. So maybe you want to go into an ETF that is S&P 500 based. That's fine. You may not ever want to sell it, but the market goes up, the market goes down. You don't really care about it. But if you ever sell it in the future, you don't have to pay tax on it until you sell it. And then you get a capital gain treatment when you do. That's another efficient way to utilize the non-IRA accounts for things that you can just park and hold and not trade. That's tax efficient. The other thing is to keep in mind tax loss harvesting. Sometimes you'll have a portfolio that'll have some gains and some losses. If every year you kind of restructure it to where you take all the dogs out and then you take some profits on the good stuff, you can offset those tax gains by creatively planning. However, if you have a good year and you don't have any significant losses and you need some money out of that account, you're going to have to sell, you're going to have to take some profits. So, there's a few different ways to skin the cat. The other things, like I mentioned in the last question, is a lot of my clients like to put most of their after-tax money in something that's like a life insurance chassis, where you make better than CD rates of return. If you look at historical rates of return, even the last few years, we've been killing any safe money returns on these things. But if you need money, you borrow it. It's kind of like a home equity line of credit. It's kind of like you buy this big death benefit. You could borrow against it during your lifetime, so you never have to pay tax on that money. Anytime you need a little extra money to pay taxes, every time you need a little extra money to go, I had a client that has more than $1 million in one, just kind of like his tax-free bank, and he called me and says, hey, if I want to buy a cabin in the mountains or something, it's $300,000 or $400,000, can I just borrow it for myself, and can I just use that money, or do I need to get a loan? No, you've already got that bank. So you basically take that $300,000 or $400,000 out, pay for the cabin, have a nice little mountain home, and that $400,000 stays in that account and continues to grow interest. The last couple of years has been over 10% a year. So let's say you make $40,000 a year for the next couple of years, you make $80,000 on money that you paid for your cabin. Oh, and by the way, you own the cabin, and that might have appreciated too. So it's a way to leverage your non-IRA assets on a tax-free basis. It doesn't generate a 1099. And by the way, they never have to pay that money back when the insured, which happens to be the wife of this couple, the multi-million-dollar death benefit is just going to pay off that $400,000 loan, and the rest of it goes to their kids. So they have a couple of boys. So they're going to get all their money back and then some tax-free, and they can use it as they want, or they can use it for steady income. I mean, their plan showed us that we could take $100,000 a year out tax-free if they just wanted to use $100,000 a year tax-free. Turned out they didn't really need that extra money. It just turned out to be where they put all their excess assets in, so they wouldn't have to pay taxes on, but they could use that money at any time for any reason, and it would never cause them a new tax bracket or cause them a tax burden. So there's a lot of tax efficient ways. If you're young enough and healthy enough to use LIRPs, great. If you're not, then we can convert things to a Roth. There's one other strategy I want to mention is some people have assets in the market that they want to kind of let grow and maybe leave to their heirs. And they know that when they're 73 years old, they've got to start taking assets out of it. You got to take about 4% called the required minimum distribution. And every year that required minimum distribution gets bigger and bigger and bigger. And if your money managers are doing a good job, your account is also growing bigger and bigger and bigger, which means every year you have to take more out of that IRA, which means every year you are flirting with going into a new tax bracket or paying more taxes. So you pay more and more taxes, the bigger the account gets and the older you get. I would prefer, rather than take 4% out of that, let's just use $1 million because it's a round number. Take a zero off if you want to use $100,000, add a zero if you want to use 10 million, whatever. But on $1 million, let's say you're 70 years old and you know that in a few years you're going to have to take those RMDs out anyway. What if you took that $1 million and just locked it into a $75,000 flat income rather than waiting till you're 73, taking $40,000 out? By the time you're 80, you have to take $100,000 out. By the time you're 90, you don't need the money. You have to take $250,000 out. Why don't you just take $75,000 or $80,000 out starting in the beginning, spend it when you're still healthy, know what your tax bracket's going to be, and keep it level at, let's say, $70,000 or $80,000 a year forever, rather than start at 40 and end up 200 when you don't need the money when you're 100, meaning you have to just kind of deplete the account. Why not just use it on a steady basis? And that would also keep your taxes a lot more predictable. And when we do that on a plan, people see that and they realize that they can even structure their income to where maybe they're making $200,000 a year to spend. But, with all the tax planning that we do, maybe you're only paying taxes on 80 or 90,000 of it, which means you're in the 12% tax bracket, not the 25 or the 30. Yet you're still living on a couple $100,000, paying taxes as if you're half as rich as you are, but living life as large as you should be on tax-free or tax-preferred income. So, if you structure it correctly, you can have foreknowledge or at least a good crystal ball into the future of what your tax situation would likely look like, barring any changes. And we know that tax changes, even permanent tax changes, aren't not always permanent. So even though we supposedly made the Trump tax cuts permanent, we don't know if they're going to stay permanent. The fact is we do know what we're dealing with right now. I do believe if taxes change, they'll get worse, not better. And I think we're kind of done with the better part. So by paying taxes now or structuring a tax efficient income plan, you'll probably be very happy in the future that you took advantage of that now rather than waiting till they change the taxes and then say, oh, what can I do to fix this? Oops, I waited too long. So again, it's very good to be proactive. Good question. Our focus is taxes. Every dollar you save in taxes, I hate paying taxes. I hate the IRS using my money. If I get a refund, they never give me interest on it back. But if I underpay by a couple bucks, they charge me interest. I don't like the way they operate. I know that I would rather do everything I can in my power to help you keep more money in your family, in your pocket, and pass on to your generations and keep it in our community than send it to Washington where they throw it down a big black hole and we never see that money again. So I figured as a good citizen, my civic duty is to help people keep more of their money and not let the government waste it. The government's got enough of our money. They have more than enough to waste. They have more than enough to take care of the things they need to take care of. I wish I could make them work a little bit more efficiently and honestly, but having said that, I'd rather us as individuals and citizens take control of our own finances the best we can. Use everything legal in the law to structure a tax efficient plan so that you not only miss the tax hits, but your heirs don't get taxed either. That's our focus. That's our mantra. That's what we do here. Tax efficient income for retirement and helping you live with confidence, peace of mind, and not giving too much money to the IRS for sure.
Jerry, thanks for listening to us in Catalina Foothills. And if you'd like to talk to Jeff about this, 520-780-9059. You can also find out more about the firm online at premrat.com. We would love to talk to you. All right, Jeff, next question is Bill listening to us in Green Valley. Bill says, are there any lesser-known strategies for protecting assets from market downturns or unexpected expenses in retirement?
I don't know. What is lesser known? I have a lot of people that never heard of an indexed annuity that's principal protected before. I know if you've listened to the show, you've heard about them because I've talked about them. LIRPs are principal protected from the downside. The unexpected expenses in retirement, like medical expense, find a cabin that you want to buy. I had a client had an unexpected event. Their daughter got a divorce and they decided to buy them a house with IRA money and then tell me about it later. I would have told them that the $500,000 they spent on a house is going to have a $150,000 tax bill. They didn't realize that. And so I said, are you going to be able to get that money back from your daughter because you just depleted your entire IRA? That was probably a bad idea. So, there could have been a couple of things we could have done to plan in advance for that. Like had they moved $500,000 from that IRA in the past over to LIRP or a Roth IRA, it wouldn't be taxable. It wouldn't have caused them so much and they would have already paid the taxes and maybe still had $400,000 or $500,000. They would at least know what the after-tax amount was that they could have used or spent on that house. I think just good planning will help you be more in tune or more aware of the assets you can use for those unexpected expenses. If it's like a healthcare crisis, the cool thing about LIRPs, I mentioned several times, a life insurance retirement plan is where you overfund the life insurance, you buy the minimum amount of death benefit so that you can stuff this policy full of extra cash. And because that extra cash is there to basically pay for the death benefit, but every extra bit of cash, you end up getting the cash back plus the growth, plus the death benefit to your heirs. But you can use that extra death benefit that you're purchasing with the interest growth on that cash that you've stuffed into this account for long-term care, for an unexpected recovery in a hospital, or heaven forbid, you get terminal illness early and need some care and you're not ready for hospice, but you still need to access some assets for those type of emergencies without digging into your spouse's retirement annuity or something. I think just protecting yourself from the standpoint of having assets that can be used for the variety of different emergencies available is smart. Some people might think, the stock and bonds are always good because they're always grow and they always give the best long-term returns. But, we talked about sequence of returns earlier. If the market's down when you go to the hospital or to the nursing home or to the assisted living facility, you're locking in losses and you're locking them in fast because those things aren't cheap. Again, just structuring your plan correctly is probably the best place to start. But as far as lesser known strategies for protecting assets from a market downturn, unexpected expense in retirement, to me, they're not lesser known. So I'm not sure really what you'd be talking about. I don't know what you know and what you don't know. So maybe the best thing to do is just come in and tell me what you know, and I'll tell you the ones you don't. And we can probably figure out a plan that'll make you a little more confident going into those unexpected times ahead.
Very good question there. And once again, Bill, if you'd like to talk to Jeff, 520-780-9059 is our telephone number. If you'd like to have a casual conversation with Jeff about your journey towards confident retirement, maybe you do have a question that you would like Jeff to answer. Again, you can get that question answered by sending it to us. We can answer it on the air, or you can have an individual conversation with Jeff at absolutely no cost and no obligation. 520-780-9059 is our number. That's 520-780-9059. You can also find out more about us online at premret.com. It's PREMRET.com. Jeff, every week I talk about the Premier Retirement Roadmap and the fact that anyone can get it by calling 520-780-9059. For the last few minutes of our program here, let's talk a little bit about what that consists of. I mean, it's really not a sales pitch. You're not coming here to sit in the room and have you sign in the dotted line. What is it really like when someone comes in for their initial conversation?
First of all, I think in the industry, it's funny. I've been to some, back early on in my career, sat in these classes on how to close business and how to secure more clients and all that. And it was like dazzle them with all this BS and get them to sign on the dotted line and then tell them that you'll come back in for an allocation meeting, show them how you're going to allocate it to get to the plan. We do it exactly the opposite. I don't want you to do anything until you've seen the plan, you know what your steps are, and we dial it in for you. We even have a narrative page that shows you the process of, okay, this is the first account we move, this is how we allocate it, then this is where we move the money later, and this is what we do over the next few years. This is when we have our annual reviews. We need a tax review in December. We have an annual review in March because that's when your account was open, whatever. This is how you'll hear about us. Listen to the radio show if you want any updates on a weekly basis of what we're thinking. And every now and then we send out a video, which I'll probably do this week again, but videos on certain things when economic related things happen, like wars and so forth. And we'll just tell them, this is how we're going to move. Now, let's find out about your situation, what you want to accomplish. We go through the 5 pillars of planning. How is your income going to be set up? What kind of investments do we need to make to support that income and not risk too much? Can we keep that risk tolerance in line with, we don't start with the investments so much. We start with, okay, retirement. The biggest thing in retirement is people need income. They need to replace the income they made in their job. So now that you know how much income you need, let's make sure that those investments support it, that they're not too risky, that they're not going to make you sick every time the market has a hiccup, and also make sure that they're tax efficient. We've had a lot of tax efficient questions and comments already in the show today. But if you can save taxes, then you don't have to be quite as aggressive on your investments, and you can have more steady income that way. So now that we talked about income, how your investments are set up, and how to make them most tax efficient, what happens when those horrible things happen later in life? Unfortunately, we get sick, we have a stroke, we have some ailment that takes us down, and we're not as functional as we used to be, and we have to go to a nursing home or maybe graduate from a long-term care facility or some sort of assisted living type community. So how do you pay for those? Do you have insurance to pay for those? Do you have assets set aside? Is it going to be the equity in your house? And so forth. And we want to address that. And the other thing is some people have kids that they want to leave a legacy to. Other people have kids, they've already left the legacy by putting them through medical school or spending half their retirement accounts on just getting them to a place where they can fend for themselves and be on their own. And they're in a position to spend every last dime. Whatever it is that you want to leave as your legacy, an empty bank account, having spent the last dime on your last breath, or whether it be, I'm going to make sure that I have generational wealth for my kids, grandkids, and generation skipping tax and all that stuff. And I'm willing to sacrifice and not spend any money to do it. Or, hey, I've got so much money, I can do both. Whatever your goals are, we want to make sure that we also speak to the legacy plan. It's not just about you getting enough money to retirement. It's what happens to your assets when you pass on. Do they get to your heirs that you want to get to with the least amount of struggles, with the least amount of taxes, with no probate and other things? Make sure that they're not burdened any further after losing you. It's hard enough to lose a parent. It's worse to have to deal with all the assets and the trouble that some parents, because of bad planning, leave their kids more struggles and turmoils, and probably situations where disagreements and fighting and all that other stuff can incur because they didn't really set it up right. So, you might need a trust to do that. You might just need the way you structure your assets and structure your accounts might already speak to that, but we don't leave the legacy plan out for somebody else to decide. We include that in the plan. So it's a 5-part plan, 5 pillars of planning, we call it. That's how we structure it. We go over, first of all, hearing all about your situation and getting the information from you that is relevant to us to create a plan. We actually build that plan. We don't charge you for it. If you want to take it and use it on your own, we can negotiate the fee for that. But if you decide not to move forward with this, well, we at least showed you what we could do, and you can move on and do things on your own. But if you decide to implement it, you have plenty of time to take it home, do different scenarios, bring it back, ask some questions, fill a book with questions, and come back several times to make sure you feel comfortable with that and you understand how the plan works. It takes time. We want to give you that time. We want to make you feel comfortable because we want you to have confidence and peace of mind in retirement.
Jeff, running a little short of time. I appreciate your time today. Again, if people have some questions they would like to ask of you about their retirement plan, call 520-780-9059. We'd love to talk to you. Out of time for this week, Jeff. I want to thank you for your time. Most importantly, I want to thank our great listeners for joining us here in the greater Tucson area. So for Jeff Vogan, I'm Jeff Shade. Have yourself a great weekend. We'll talk to you again next week right here with another edition of Premier Retirement on 790 KNST, Tucson's most stimulating talk.
Investment advisory services provided through Premier Wealth Advisors, LLC, an Arizona state-registered investment advisor. Securities transactions are placed through TD Ameritrade. Insurance and annuity products are offered through Premier Advantage Inc., DBA Premier Retirement Planning and Wealth Management. Investing involves risk, including the potential loss of principal. Any reference to protection, safety, or lifetime income generally refer to fixed insurance products. Insurance guarantees are backed by the financial strength and claims paying abilities of the insurance carrier. This show is intended for informational purposes only and is not to be construed as advice or recommendations. Due to show format, accuracy, and completeness cannot be guaranteed. Premier Retirement and its representatives do not provide legal or tax advice and may only conduct business with residents of states and jurisdictions where they're properly registered.